Wirecard's collapse is a teachable moment for investors. The German payments company filed for insolvency last month after admitting that about 1.9 billion euros of its cash was probably fake. Shareholders couldn't have known the exact extent of its problems, but with hindsight, many of the red flags spotted by journalists at the Financial Times and many short sellers could actually hold lessons. Start with debt. Wirecard claimed that it had a lot of cash on its balance sheet, but it also borrowed very heavily to finance its activities. The company, for example, said it started 2019 with about 1.5 billion euros of cash and then produced a ton more over the next 9 months. That should easily have covered its outgoings over the next 9 months, but instead it borrowed heavily, including from bank lenders and also from bond markets. This reliance on outside financing now makes sense because we realise that a lot of the cash it was reporting may not actually have been real. But the lesson is that investors should be wary of companies that don't seem to be using the resources they're claiming to have on their balance sheet. Then there's governance. For years, Wirecard's board was tiny with just 3 members, and it also met very infrequently. Finally, it awarded massive cash bonuses to executives, including the former boss, Marcus Braun. These awards were based mostly on the short-term share price performance, which gave him and other executives a very strong incentive to keep the share price up in the short term. The extent of Wirecard's potential fraud was hard to spot from the outside, but investors can certainly learn from the warning signs.